Good day. Welcome to another session of Folk Tutorials. Today we are going to look at accounting books, or what you may call the books of accounts. We are going to look at the various accounts into which transactions are recorded in accounting. And so I don't want to waste much time. I want us to go straight into understanding the various types of books and what they are meant to record. Now, accounting books are the various books into which transactions are recorded in accounting. So the various books into which we record business transactions in accounting are called accounting books. Now, accounting books can be broken down into two broad classifications, and they are the subsidiary books and the principal books. So we have the subsidiary books and we have the principal books. Now, the subsidiary books of accounts are the books into which transactions are first recorded before they are posted into the principal books. And so these books of accounts are usually the books of first entry. And so you can have so many names for these types of or category of books. You can call them the books of original entry. You can call them the books of prime entry. You can call them the day books because daily transactions are recorded in them. You can call them the journals. And so there are a lot of names for this book. We call them journals. We call them books of original entry. And then we call them day books. And then we call them books of prime entry. Okay, so whatever you choose to call these books, whether you are calling them the journals, books of original entry, day books, or books of prime entry, they mean the same as the subsidiary books. And then we have the principal books. The principal books follow the double entry system, but the books of original entry do not follow the double entry system. So that is the difference between the subsidiary books and then the principal books. And so we are going to look at what books come under the subsidiary books and then what books also come under the principal books. And then from there we'll look at the functions of each of the book, the uses, what they are used for. I'm sure that will enhance our understanding, especially when we are supposed to do bookkeeping. And more importantly, for the topic of correction of errors and the suspense account, most of the time the principal books are used in there, and then most of the students, because they don't understand the accounting books and which books are used for what type of transactions, most of them, when the books are used instead of the names of the accounts, they get confused as to which kind of account they are referring to. And so quickly, let us look at the books and then the uses of each of them. But before that, let us try and classify accounting books under both the subsidiary books and the principal books. Okay, so this is what I'll do. I'll just draw a table like this: subsidiary books, and then I'll call this column principal books. Okay, so there are 6 subsidiary books, and then there are 2 principal books in general. So what we are going to do is that we are going to list them. So for the subsidiary books, we have the sales journal, or what you may call the sales day book. I told you they are called day books because transactions are recorded in them daily, and they are called journals because transactions are recorded chronologically in the order of occurrence. All right, and then we have purchases journal, and then we have the sales returns journal, and then we have the purchases returns journal. Okay, so these are the first 4, and then we have the general journal, and then finally we have the cash book. the cash book. So these are the 6 books of original entry, or what you may call the subsidiary books, 6 of them. When we get to the principal books, we have 2 main classifications. The first one is the ledgers, and then also we have the cash book as well. Now I'm sure you're asking a question that why is the cash book appearing at both sides? Now, these books of original entry are the books into which transactions are first recorded, because we do original entry here before we post them into the ledgers. Okay, but we are told that these books do not follow the double entry system, but the ledgers do follow the double entry system. And so what we are going to do, what we are saying is that because the cash book follows the double entry system, it is permitted to be part of the principal books, even though it is a book of original entry. The cash book is the only book of original entry that follows the double entry system. The rest do not. And because the cash book follows the double entry system, it is permitted to be part of the principal books, because the principal books are the books that follow the double entry system. And so these are 6 subsidiary books and 2 principal books. And so I can draw a diagram like this for you to further enhance your understanding. I'll call the universal set as AB, accounting books, and then I'll call this the subsidiary book, the first circle, and I'll call this the principal books. And so what I'll do is that I'll put the cash book into the middle like this as an intersection to let you understand that the sales journal, the purchases journal, sales returns journal, purchases returns journal, and then the general journal will be inside the subsidiary book for those of you who are mathematically inclined. And then when we get to the principal books, the ledgers will be standing alone. And then there will be an intersection called the cash book. So what I want you to know is that the cash book is a subsidiary book, and at the same time it is a principal book. Okay, so what we are going to do is that we are going to take each of these books under their categories one by one. So we are going to start with the subsidiary books. And what I'm going to do is that I'm going to explain the uses of each of these books, and then from there we'll pick up from the principal books, and then we'll look at them extensively as well. And so that is what I want you to know for now. Okay, so we are going to look at these books and the uses of each of them. Now we are going to explain them into detail. Now let us begin from the sales journal. Now the sales journal, if you want to, now let's first of all, before I will teach you how to define them, let us look at the uses of each of them. Now the sales journal is specially made to record only credit sales. So whenever the business makes credit sales, it is recorded in the sales journal. And I said credit sales alone. So apart from credit sales, nothing else is coming into the sales journal. Then we go to the purchases journal. The purchases journal is specially made for credit purchases. For credit purchases. And I'm sure by now we understand the concept of sales and purchases. That sales refers to the disposal of stock. And then purchases refers to goods that are bought for resale. And so the acquisition of a non-current asset does not constitute purchases. Take note. And then the disposal of a non-current asset does not constitute sales. It should be your stock that you are using in your normal trading activities. It is that which you call purchases when you buy them, and it is that when you call sales if only you are selling them. And so sales refers to disposal of stock. And what I mean is that the sales journal is used to record only credit sales, specially made for that. The purchases journal is used to record only credit purchases, and so you do not have to record cash sales or cash purchases in any of these two for any reason, because they are made specially for credit sales and credit purchases respectively. And then when we move to the sales returns journal, the sales returns journal is specially made to record returns of credit sales. And so when we make sales on credit and the customers decide to return some because maybe they are faulty or for whatever reason it may be, we record that in the sales returns journal. So returns of credit sales. So it means that the sales returns journal is specially made for returns of credit sales. And that means that the purchases returns journal is also specially made for returns of credit purchases. These are all specially made for just one single type of transactions. Then permit me to skip the general journal and then move to the cash book. Now, the cash book is also specially made to record all cash transactions. The cash book is specially made to record all cash transactions. Take note that for the sales journal and the purchases journal, I specifically made it clear that we are recording only credit items for sales and purchases. And these two other books are to cater for the returns of those two credit items. That means that we have not said anything about cash transactions. Now, with a cash book, I am saying that a cash book is used to record all cash transactions, whether it being cash sales, cash purchases, cash acquisition of non-current assets with cash. Once the item is a cash transaction, and we know cash transactions could be by either physical cash or check, will be recorded in the cash book. And so you could see that apart from this general journal, each of these 5 that I have mentioned are specially made for special purposes. And so we call them special journals. Special journals. So take note. Now, the general journal. Now, you could see that we have mentioned for sales and purchases and their returns on credit. And we have mentioned all cash transactions. Now, there could be a transaction that is not a credit sale or credit purchases. Neither is it a return. Sorry. And then it is also not a cash transaction as well. And so those transactions will be recorded in the general journal. So the general journal is there to cater for any other transaction that do not find its way into the special journals. And so the special journals are 1, 2, 3, 4, and the cash book making 5. The general journal is not part of the special journals. And so the special journals, when they fail to record any transaction, or if there is any transaction that cannot fit into the special journals, then we record that in the general journal. So we will say any other transaction. All right, so I have seen in the exam, especially for those who are writing exam, accounting exam with objectives, I have seen in some of the past questions before that there was a question where they asked which of the following is not a special journal, and the options were a sales journal, purchase journal, the general journal, and the cash book. And I saw a lot of students choosing cash book as the answer because the cash book does not end with the name journal, and so they thought that is not a special journal. No, what I'm telling you is that the general journal is not a special journal. The cash book is part of the special journal. And so take note. So now that we have understood the purpose of each of these books, let us try to attempt defining each of them. So let us assume you have gone to the exam when you are asked to explain any of them or define any of these. So we begin from the sales journal. To define the sales journal, we are saying that it is a subsidiary book. And so you will say that the sales journal is a subsidiary book of account that is used to record credit sales. Perfect. The purchases journal is a subsidiary book of account that is used to record credit purchases. Perfect. Then you come to the sales returns journal. The sales returns journal is a subsidiary book of account that is used to record returns of credit sales. Now the purchases returns journal, or what we call returns outwards journal, is the subsidiary book of account that is used to record returns of credit purchases. So you can define in that order for each of them. The cash book is a subsidiary book of account that is used to record all cash transactions in a business. And then finally, when we get to the general journal, we will say that it is the subsidiary book of account that is used to record any other transaction that do not find its way into the special journals. I believe I have made myself clear with these books. I'm not going to go into the practicals today. We may go into the practicals of each of these books later. But for now, I just want you to understand what they are, their purposes, and what they stand for. So these are 6 subsidiary books that are used in recording transactions. So one more thing that I would want to add to the concept of the subsidiary books is that they have source documents, and so we should be familiar with the source documents that are used to record in each of these books. And so what I want to do for now is to just quickly or briefly list 1 or 2 source documents that are in at least one each for them. Now, the source document for recording in the sales journal is the invoice. Now, for the purchases journal, it is the invoice as well. Now, take note that for the invoice, the same invoice to the buyer is seen as a purchases invoice, and to the seller it is seen as a sales invoice. And so for the sales journal, we will say sales invoice, and for the purchases journal, we will say purchases invoice. And then when we come to the sales returns journal, mind you, another name for the sales returns journal is the returns invoice journal, and then the purchases returns is the returns outwards. And so for the sales returns, the source document is the credit note. The credit note is the source document for recording in the sales returns journal. Why is it called credit note? Now, it is called credit note because, now, remember that when you sell to anyone on credit, the customer becomes a debtor to you. Now, the debtor has a debit balance, meaning that you debit the debtor's account. And so when the debtor returns goods to you, the debtor will attach a credit note. The reason for the word credit is that it is informing you to credit the debtor's account so that you can reduce the debtor's balance, because the debtor's balance is standing at the debit side of the account. And so when they return, they accompany the returns with a credit note, so that by that credit note you will credit their account. And that is why the sales returns journal source document is a credit note, and then the purchases returns is the debit note. Now, the same way, why is it called a debit note? It is called a debit note because when you purchase on credit from a supplier, the supplier becomes your creditor. And when the supplier becomes your creditor, their balance stands on the credit side of their account. And so when you return, you accompany yours with a debit note to tell the supplier that you are going to debit their account to reduce the indebtedness that you have towards them. So that is why the source document is called the debit note. And then with the general journal, we have the general voucher, which also is used, and there could be other source documents over here. And when we get to the cash book has so many source documents to be used in recording. We can use a lot of source documents. We can use receipts to record in the cash book. We can use checks. We can use check counterfoils. We can even use invoices to record in the cash book. And so the cash book has a lot of, we can use the bank statement to record in the cash book. There are a lot of source documents for recording in the cash book, depending on the type and the nature of the transaction. And so these are an overview or a quick overview of the subsidiary books, and then their source documents, their definition, and the purposes for which we use them. And so take your time and look at it well, get your understanding. In another video, we are going to go into the format of each of them and then try and calculate some questions concerning that. So these are subsidiary books. So if your understanding is okay, then we move straight away and quickly to explain the concepts of the principal books. Okay, so we now move to look at the principal books. Now, the principal books, I told you, are basically 2 classifications. We have the ledgers and the cash book. Now, listen very carefully, because this is where most of us don't understand, especially when we are solving questions involving double entries or questions involving correction of errors and the suspense account. Because most of the time the ledgers are used and we don't even get what it means. Now, we are going to break them down. There are 4 different types of ledgers, which are also classified under 2 different broad classifications. And so we are going to take the ledgers and then get deeper understanding of them. And then we come and pick the cash book, and then we'll look at the types of the cash book that we have as well. And so let us begin with the ledgers. Now, with the ledgers can be broken down into personal ledgers and impersonal ledgers. So we have personal ledgers and then we have the impersonal ledgers. Now, the personal ledgers are the sales ledger and then the purchases ledger. These two ledgers are called personal ledgers, the sales ledger and the purchases ledger. And then the impersonal ledgers are the general ledger, which is also called the nominal ledger. And then we have the private ledger. So these are 4 different types of ledgers, which are also classified under 2 broad headings. So we have the personal ledgers and the impersonal ledgers. Now take note very carefully. And when we get to the personal ledgers, the name sales ledger does not mean that the sales ledger contains accounts of sales. The purchases ledger does not mean that the purchases ledger contains accounts of purchases. Now, we defined accounts from our previous lesson. When we were doing the double entry, we said that an account is a page of a ledger. So a ledger is a book. When you take the book called the ledger, every page is an account. Now, the page of every ledger is divided into 2, like this. So it's like a T, and there is a bar on top, which records the title of the account in here. And the left-hand side of the page is called the debit side. The right-hand side is called the credit side. So when you flip every page of a ledger, what you see there is what we used to call, or what we call, an account in terms of double entry recording. Now, it means that a ledger is a book that contains accounts. And that is why we are saying that this book follows the double entry, because double entry recording is done in the accounts. And the accounts are found in the ledgers, because the page of a ledger is an account. Now take note that when we say the sales ledger, it is a book, but it does not have the sales account. The sales ledger is a ledger that records accounts of debtors. Who are debtors? Debtors are people or customers that we sell to on credit. The moment you sell to a customer on credit, the customer becomes your debtor. And so we open a different book called the ledger for them. And in that book, every account you see in that book is an account of a debtor. And that is why the sales ledger is also called debtors ledger. And so when you see sales ledger, it means that the account, every account in the sales ledger is a debtors account. So this sales ledger records accounts of credit customers or debtors. I told you in our previous videos that we don't open accounts in our books for people we sell to by cash. We only open accounts for those we sell on credit, or we also buy from on credit. It is a credit transaction that will give rise to me opening or you opening the name of a business or a person in your book as an account. And so purchases ledger can also be called creditors ledger, because in the purchases ledger, accounts of creditors are found. Take note that the sales account is not in the sales ledger. Purchases account is not in the purchases ledger. As a matter of fact, both sales account and the purchases account, both of them can be found in the general ledger. And so these ledgers do not contain sales nor purchases account. No, sales account is found in the general ledger, purchase account is found in the general ledger. So you should take note and find the difference between the sales ledger and the sales account. They are not the same. The sales ledger is a book that contains accounts of debtors. So this one contains accounts of debtors. And then this book contains accounts of creditors. And that is why we call them the personal ledgers, because these are personal accounts. Accounts of debtors are personal accounts. accounts of creditors are personal accounts, whether they are human beings or business organizations. I told you that in accounting we have natural persons and artificial persons. Natural persons are human beings, artificial persons are business organizations. And whether they are human beings or organizations, any account of them in our books is a personal account. And because those accounts can be found either in the sales ledger or the purchases ledger, then we'll classify these ledgers as personal ledgers, because these ones do not contain accounts of persons. That is why we call them impersonal ledgers. So you have to take note of these classifications and get them right. And so that is the sales ledger and the purchases ledger for you. Then we go to the general ledger and the private ledger. Now let me go to the private ledger. The private ledger, I don't know if practically it's in existence now, but the purpose of the private ledger is to record the owner's private account. I don't know how many organizations are still operating the private ledger, but I'm sure it's still in existence. Now, the private ledger should contain the owner's private personal account, which usually is locked in a safe in a typical organization. And these accounts are the capital account, the loan account, drawings account, and then the profit and loss account. These four accounts are seen as the private accounts of the owner, which is not supposed to be made visible to all employees or the general public. And because of that, we put them in a different book, and usually those books are not made available. They are locked except they are needed to be used. We don't show the capital that the owner is using to run the business to everybody, the loan that they have taken, their drawings that are being made, and even the profits that they are making. And that is why this ledger is containing these accounts. Now, just like we did for the general journal, we have been able to define specially for each of these. It means that any other account will be found in a general ledger. That is why it has the name general. Another name is nominal ledger. So when you see the nominal ledger, we are referring to the general ledger. And so the general ledger records any other account, or is a book that contains any other account that is not either a personal account or a private account of the owner. That is how the general ledger operates. And so take note that if you want to define a sales ledger, the sales ledger is a ledger that records accounts of debtors. The purchases ledger is a ledger that records accounts of creditors. The private ledger is a ledger that records the personal accounts of the owners. And then the general ledger is a ledger that records any other accounts apart from personal accounts and the private accounts of the owner. I'm sure you'll be fine, and I'm sure your understanding has been enhanced in the ledgers. And so when you are doing correction of errors, for example, and you see something like sales on credit to Ben has been recorded correctly in the cash book. Sales on credit to Ben has been recorded in the sales account, but no other entry has been made to the personal account or has been made to the sales ledger. Once they mention sales ledger, you know that they are referring to Ben's account, because Ben's account can be found in the sales ledger. Sometimes they can tell you has been recorded correctly in the personal account, where you know the personal account is Ben's account, but no other entry has been made in the general ledger. Instead of saying sales account, they will say general ledger. They expect you as an accounting student to know that once the transaction is between Ben and sales, if they mention general ledger, you should know that the sales account can be found in the general ledger. And that is it for the ledgers. So I'm sure that by now your understanding is enhanced with the ledgers as well. And then the cash book. So we'll look at the cash book as well. Now the cash book, we have the single column cash book, and then we have the double column cash book, or what they call the two column cash book. And then we have the three column cash book, or the triple column cash book. Now, we even have a fourth cash book called the petty cash book, which is also a type of cash book. And so these are the types of cash books that we have: a single column, the double column, three column, and then the petty cash book. Now, the single column cash book The single column cash book is a cash book that has only one column for amount. So usually when you have a cash book, you have a column for dates, a column for particulars, and then maybe your ledger folio, and then the amount column. Now, the same applies to the debit side. This is the credit side. Now, the amount column, if the amount column is just one, then it means that the amount column is either recording for cash transactions or for check, bank transactions. And so it could be either bank or cash, and we call it a single column cash book. Now, when we get to the double column cash books means that the amount column is divided into two, so that one side will cater for cash transactions and the other side will cater for bank transactions. And so we are not going too much into the format. I'm just trying to explain the concept so that in our next video concerning this, we'll come back, look at the format, and then pick some examples. Okay, so this is why we call that the double column. Now, when we get to the three column cash book, the three column cash book divides the amount column into three. So that is basically the difference. Divides the amount column into three, and one will cater for discounts and the other for cash and for bank, meaning that inside the same cash book we are providing for discounts, so that whenever there is a discount allowed or discount received, we'll be able to deduct that before we record the amount. So that is basically the single column and the double and the triple column cash book. So the difference between them is just about the amount column. The format will be the same, but the single column cash book has one column, either the cash column or the bank column. The double column has a column for both cash and bank, and then the triple column has three columns for amounts, which is discount, cash, and then the bank. All right, when we get to the petty cash book, now the petty cash book is not used by every organization. It depends on the type of organization. Now, we know that there are some organizations that have very huge cash flows, and so their inflows and outflows of cash are always in millions of cedis or dollars or whatever. Now, if such an organization wants to spend $8 or $10, maybe their regular cash flows are on the average around $10,000, $50,000 and all that, and maybe they want to spend $1 or $2 to buy something. Recording that in the main cash book will make that look too insignificant, and so because of that, what they do is that they create a fourth cash book called the petty cash book. The petty cash book is a cash book that is used to cater for petty cash expenses that are being made. The nature of the transactions are such that the amounts are so small that we don't want to mix them up with our main cash book inflows and outflows, and so we will create a petty cash book, and then we'll give that to one person in the office to be in charge, and then at the end of every period we give something called an imprest, and so the imprest would be used to cater for those petty expenses until the imprest is finished, and then we do what we call reimbursement, and we give them back what they have spent so that they will continue for the next period. That is what we mean by the petty cash book. And so the petty cash book only comes into play when the cash flows are so huge that the other transactions that are too small cannot be mixed with them, and then we create the petty cash book, and then we use that in the business. And so when we move forward with the practical aspect of the accounting books, we will look at how the petty cash book is actually operated, and we'll solve practical questions on each of all that I have explained, from the subsidiary books through the ledgers and the cash book. I'm very sure that you have really been helped with these explanations. If you have any question, don't forget to send them in the comment section, or you can WhatsApp that to me for clarification. Please subscribe to the channel, share, and let others also have a benefit. Recommend this channel to your friends for them to also come and have a benefit. Don't be selfish. Share this information, and I'm sure that all of you will be fine in your studies of accounting. God bless you. Until we meet again, it is bye for now.